Okay, there's a thing called the Santa Claus Rally. Santa Claus is actually an American expression, but it is the idea that the stock market always goes up in the last 2 weeks of December, and statistically it does. If you look at a 50-year chart averaging the performance every day of the year for the All Ordinaries, you'll see in December we usually have a really good rally into the end of the year. It actually carries on in January and peaks out in May, and then you have 2 months of going down, sell in May and go away, and then a general rally. But there is this particular rally in December, which of course is coming up, called the Santa Claus Rally. The reason it's called Santa Claus Rally is because it is thought to be caused by the American financial year end, which ends on December the 31st. Our financial year end is June 30th. So it's not our financial year, it's the US, and the Australian market follows the US market, so we see the same phenomenon. And the idea is that a lot of American investors, particularly individuals, companies, make investment decisions at the end of the financial year when they do their accounts, talk to their accountants, financial planners, and decide, oh, I've made a profit, or I've got this money, or I need to do something. It's the new year, so I need to do something sensible with my money. So I'll make an investment decision, and a lot of new money arrives in the market in January from people making strategic decisions about their investments in early January after the end of the financial year. And so you get this money arriving in January, and the Santa Claus Rally is thought to be people buying in anticipation of a lump of money being dumped into the market in January. So you get this buying in anticipation of the January money, and then you get buying in anticipation of the buying in anticipation of the January money, and before you know where you are, we have quite a good December. That's where it comes from. I would tell you that if that is repeatable and true, then maybe there is some veracity in it. But after 42 years in the stock market, I get fed up of highly paid analysts in broking houses who add up past statistics. Wherever there are numbers, there are going to be statistics. So even if there was no seasonal reliability, if you added up every month of the year, you're bound to get a good month and a bad month. And then to say that it's going to be a good month because it was a good month on average in the last few years is hollow. So I get fed up of analysts telling us past statistics as some sort of, and projecting them as some sort of shrewd prediction for what's going to happen next. One of the most obvious ones is, on average, in a presidential election year, the stock market goes up X. Well, of course it does. It doesn't mean it's going to do that every election year. Where there are numbers, there are statistics. Anyway, statistically, which has no veracity in my humble mind, statistically, we usually have a really good last 2 weeks in December.